Hello and welcome back to The Note, still coming to you this week from the CFA Institute's annual conference here in Seattle, Washington. Today we're going to be discussing one of the most famous dictums of Oscar Wilde. A cynic, he said, knows the price of everything and the value of nothing. Could you make the same complaint about value investors? It's a Wilde, very strongly respected philosophy of investing, but do we run a risk when we confuse the notions of price and value? With me now to discuss this is one of the world's foremost experts on this subject. He's NYU Stern Business School's Aswath Damodaran. Aswath, thank you very much for joining me today.
You're welcome.
So, what exactly is the difference between price and value? Why is this a problem for investors?
I think the best way I can explain it is with an analogy.
Right.
Let's suppose you go to look at a house that you want to buy. Your realtor points to the house, she names a price, or he names a price. And you say, where did you come up with that number? And the reality is, he or she came up with that number by looking at other houses in the neighborhood and what they sold for. A lot of people invest the same way. If you ask them, why are you paying $50 for Twitter or $600 for Apple? The reality is they haven't valued the company in any real sense. They've priced the company by looking at what other people are paying for the stock. Okay. That's the essence of the difference. Price is based on what other people pay. Value is based on what you think you can get back in cash flows from investor.
Okay, now let's explore this with reference to a very interesting example, one of the phenomena of our day, Apple. You produced this fascinating chart. Apple, as we speak, is back up through $600 per share. This fascinating chart showing how valuations of Apple have shifted over the last few years and how the price has shifted. What on earth does an investor do when trying to put a price on a company like Apple?
I think Apple, to me, is more than a company. It's a company that I've been fascinated, even obsessed with for the last 25 years, maybe even 30 years, because I used my first Apple then. I actually bought Apple stock in 1997 because I felt sorry for the company. I thought it wouldn't make it. And it turned out to be the best investment I'd ever made.
Even though it was not the most rational basis on which to buy anything.
In fact, it was a completely emotional investment. And that's why I tell people, those who argue that they can be completely rational in their decision making are far better than I am. Right. So I've been valuing Apple off and on since '97, but I've actually started intensively valuing Apple since 2010, which is when the company went into this, it started zooming. The stock price went from 300 to 400 to 500 to 600. And my first valuation of Apple was in early 2011 when I valued it about 480 and the stock was at 300, and I thought it was undervalued. And over the next year and a half, the stock didn't just catch up, it went right through my value. In fact, by September of 2012, the value had hit 650. And, I'm sorry, the value had about hit 650, but the price had gone to 700.
So this is a classic example of momentum among investors, which many academics have documented is there. People got ever more excited about it, referred to the rise that they had seen recently and expected it to carry on rising into the future.
Exactly. And the problem with mood and momentum is it's not based on anything rational. It's based on the fact that you're buying because everybody else is buying. And that includes not just individual investors, it's actually primarily institutional investors. They're the biggest mood and momentum players on the face of the earth. Even though they might call themselves value investors, they're really momentum players. And they pushed Apple right through the value up to 700. So in the middle of 2012, I started to get wary about Apple's price catching up with the value.
When did Steve Jobs pass, remember?
It was 2011. He stepped down in 2011. Tim Cook came into place. So that was an added factor in here. But for the first year while he was CEO, Tim Cook was CEO, the price continued to go up.
Right.
Then it was amazing because sometime right after the iPhone 5 introduction in September, the mood suddenly shifted. And that's the nature of mood. It can shift on a dime. It can go from being incredibly optimistic, when the company could do no wrong, to a period where the company could do no right.
Now, what is your explanation for the way Apple have not produced any new product in many months, as far as I'm aware? Why have we suddenly seen this closing of the gap once more positively in the last few weeks? What's been the catalyst for that?
I think the mood that started pushing Apple down overreacted. It pushed Apple down because Apple wasn't creating the next great disruption.
Right.
But it pushed it down to a point where if you looked at what you were paying for Apple and what you were getting back as cash flows, He said, this is the greatest investment on the face of the earth. This company, even if it does not disrupt another market, is a cash machine.
But what catalyzed other people in the market to realize that so that price caught up with value?
And I think the problem is I can't put my finger on any one thing, but if you look at last week and you look at the collection of actions that Apple announced, it announced an increase in dividends, which it's been trying for a couple of years. It announced another big buyback, which it's been announcing for a period of time. It announced borrowing, which it did last year as well. And none of those worked last year. But it announced a stock split, which if you think about it, is the most innocuous of all actions. It changes nothing. It changes the number of shares.
Yes.
And that, for some reason, seems to be the trigger that shifted the mood in the market. Go figure.
Now, final question then.
Yeah.
With respect to Apple, but it will obviously has broader application, how can you possibly go about predicting what your return on your investment might be in another 6 months or a year or 5 years buying now?
I'll start with the 6 months. It's impossible. People who claim that they can forecast what they will make in the next 6 months are either incredible traders. They're not investors. They're good at reading mood and momentum. I invest for the long term because I need time to be my ally in this process, because only then can price adjust towards value. So over the next 5 years, I hope that if I've done my homework right, my values turn out to be right more often than wrong, and the price does adjust to the value.
Okay, Aswath, thank you very much indeed. I think the ultimate message, there's one important message, that price and value are different concepts and we mustn't confuse them. The other very important thing, I think, is that we all need to remember, even if we're value investors who've done a lot of homework and number crunching, we all need to remember that we have to be extremely humble. It's very hard to beat the market.